Hey, hey, hey. It's time for another Ask an Agent. Yes. So we are back with another fantastic episode of Ask an Agent. And tonight I have as my very special guest, Mr. George Wise. Ooh, I cannot wait for you all to meet Mr. George Wise, honey. His name just speaks volumes, okay? So I am getting ready to merge George on the call so we can get started with this fantastic, phenomenal info. You'll see him. Oh, hey, yes! Hi, George.
Hey, Miss Cole, how are you, my dear?
I am awesome. Thank you so much for asking, and thank you so much for joining us tonight on Asking Agents. Yes.
I am honored to be here. So,
Well, George, I see you've got your pool sticks in the background there. Do you play a little pool?
every once in a while, I play a little pool. I'm sitting there doing the meeting in my game room. I do apologize if one of the little people come in.
Okay, no worries.
Being great,
We understand. We
but
understand. It's okay. All right, so what we're going to do now is jump right into it. So, ladies and gentlemen, welcome again to Ask an Agent, where you get to get your questions answered live. Today's guest is George Wise, Senior Loan Officer with Summit Funding. And guess what? Mr. George Wise runs his own team, okay? As do a lot of lending agents, they run their own teams. But I'm telling you, George will be like, look, if this is regarding your loan, call my team. It's funny, but you know what? He is doing amazing things in this industry. And when people were like, you always have a women guest, you always have a women guest. Do you know what he meant? I said, all right, let me start getting my guys on. And I reached out to George, and George said, I'll be more than happy to jump on this live with you. So, George, welcome again to the live. Tell us a little bit about yourself and how you got to where you are today.
oh wow, okay. So George Wise, been doing mortgages for 14 years now. So I got into this 14 years ago by chance. I was doing insurance before this, fresh out of college. I was doing insurance for 1 year. That job, they were shutting down the entire division. I heard that mortgages was a pretty good industry at the time, so I jumped in. And shortly after I jumped in, we had some turmoil in the industry, but I was able to rebound from that pretty quickly, which I'm grateful that I jumped in at the time that I did because I had a chance to learn the industry at the worst of times, which allowed me to perfect my craft, right? It forced me to do some tougher deals, forced me to learn some things that other folks were not prepared to learn or just didn't know. So I got it at the absolute perfect time. I've worked my way up year over year to become one of the top LOs in my company. Last year, I was honored to be recognized as one of the top 1.5% of loan officers in the nation, which was mind-blowing to me, to say the least. And now, as you said, I have a wonderful team of individuals that provide amazing support and make sure that we take care of our realtor partners as well as our clients.
Awesome. Congratulations. I didn't know you was out there doing it like that. Congratulations to you. That is fantastic. Look, every time George has these lunch and learns, he has these events where he brings in his realtor partners just so we can learn, so we can do better in the industry. And I love it. And he always does it top notch. Y'all, last time, okay, we George knows exactly where I'm going with this. Okay. Last time we was on South Boulevard at that fancy restaurant. What was the name of that restaurant, George?
Sullivan's.
Sullivan's Steakhouse. Yes. And y'all know, honey, I love a good steak. So I'm just saying. If you want to partner with somebody, this is who you need to partner with, okay? He does it right. He does it top notch. But listen, George, I've got a lot of people jumping in on this live because they know that, hey, you didn't get to be a top producing loan officer, LO, as you say, without doing some things and doing it right. And the only way you can do some things and do them right is you have to tell people right. Okay, so I'm gonna start out asking you, and again, audience, as you have questions, you can type it in the chat box, and I'll ask those questions as well. But George, I'm gonna start out asking you, what have you seen to be the toughest thing in this market?
Well, right now, the toughest thing in this market is getting offers accepted, right? It's very competitive. The price points are going up in the area. Rates are super low. Money is as cheap as it's ever been, and even more so. People are starting to realize that the price of the home is less important than the price of the loan. You pay more than half your repayment back on interest rate alone. So, whether you're buying at the top of the market or the bottom of the market, if you're getting a great rate, you're paying less overall for the home. So with people being aware of that, it's more challenging to get an offer accepted because more people are out shopping right now. So you want to make sure that you're being aggressive in your shopping. Second to that, I would say getting appraisals done quickly, because in addition to people that are buying homes, there are a ton of people refinancing their homes. Keep in mind 2 years ago in 2018, or 2.5 years ago in 2018, rates were about 5.25. Now, we're calling 3.25 a high interest rate. So there's a ton of savings on the mortgage terms. Then lastly, and I know you work with some great attorneys, but getting title back quickly in the midst of the pandemic, and all courthouses aren't open up fully. So you got to make a reservation to go down and pull a title for people. So what was a 3-day turnaround is now sometimes a 13-day turnaround. So it is most definitely a challenge in making sure that everyone is being diligent in their offer, in their negotiation, in providing documents up front to make sure we can get them closed in a timely manner.
You said a key thing there that I just want to take a pause on. Getting your documents in up front. I can't stress that enough of how important that is. George, why should they get their documents in up front?
Wonderful question. So in the market that we're in now, when people are deciding, if you have 22 offers on a home and which one closes the fastest, well, if I have all of your financial documents, W-2s, pay stubs, if I need tax returns, etc., I can close your loan between 18 to 21 days. Well, if everyone else is 30 to 45 days, our offer now looks more attractive and more aggressive than everyone else, because who doesn't like getting paid earlier, right? So if you're home, you want someone who's going to pay you quicker than someone that's not. If I don't have all your documents up front, there's no way I can close you quicker than someone else. So get your documents to me right up front. Then it also allows me the chance to prevent any surprises. So if you give me everything up front, I can look at your W-2s, I can look at your pay stubs. I can see things that could pose a challenge from a lending point of view before they are a challenge in underwriting. And I can protect you from any downfall in underwriting.
Now, your answer prompted another question. If you all in the audience have other questions, be sure to put them in the chat. I'll get to those as soon as I can. But your answer prompted another question, and that was, you could kind of head off some things up front. What is some kind of things that you could possibly head off?
So there's a lot of things that we see that folks just don't always realize. For example, I had a client once that somehow from 2016 owed the IRS $42. And the IRS just took it out of their paycheck randomly 1 month, and they didn't think anything of it. They called the IRS, explained it, and they said it was 5 months prior to them buying the home. Well, the thing is, we got that paycheck from them, and it showed that they had a $42 IRS tax withdrawal. So now we got to get documentation showing that you don't owe the IRS money, you're not on a monthly payment plan. There's a lot of documents going hand in hand with that. If we have to wait to get those documents while we're under contract and the IRS is shut down, we're under contract for 30 days and they're telling you 60 days before you get this document. These are things addressed right up front. Also, bank statements, the most recent bank statement. If you had a large deposit in your bank statement because you got a tax refund or you got a school refund because you're in school, right? Those are things we need to document and show sourcing and proofing of. There's Anti-Money Laundering Act. So we have to document a lot of the money that goes into your account if it doesn't say where it came from. And sometimes when it says where it came from, we need to know where it came from and more information. So everything, just like our webinar now, everything that you provide the lender has potential to spark another question. Lending is not super black and white. It is every color on the spectrum. So we have to prepare for every surprise.
You said in this, again, you prompted another question. I'm loving your answers. But you prompted another question because last week, this is to my audience, you remember I had an actual loan underwriter on the line. And one of the things she said to be careful of when you're giving your documents is giving more than what is asked for. Do you see that happen a lot?
So there's the divide right there. That statement from the underwriter should really be geared more towards the lender. Now, in the world we're in now, in the cut rate world, there are a lot of companies trying to take the actual loan officer out of the picture and connect the consumer directly with the underwriter and leave them with no protection, right? So imagine you're driving down the Autobahn without a seatbelt on. Doesn't make a whole lot of sense. You need someone in there to protect you, being myself, and to guide you to that final destination. So when someone sends me send me these documents, I'm going to see what I need to see and not see what I don't need to see, as long as obviously I'm not crossing any legal lines. But I can look at someone and say, hey, listen, we have a W-2 buyer, we have tax returns. There's something on these tax returns that's not super flattering. We're not going to pay attention to those tax returns and only use the W-2s, right? So as an experienced professional in mortgages, I'm going to know what to give and when not to give, because that underwriter was right. Sometimes more is too much. Less is the right amount. We always aim to give the bare minimum to underwriting. I tell my clients, give me everything so I can find the surprise, and then I will give underwriting what they need. And if there is a surprise that they find, I'm prepared to fight it before they even find it.
Now, that's the kind of loan officer you want, people, somebody who's going to fight for you up front. Yes. Good job, George. So let me see here if we've got any questions from our audience. A lot of times I will have people who have to sell a home and buy a home, and they're like, hey, listen, the market is tough. What are some things as a seller who I'm looking to now go buy, that I need to be prepared to have for my loan officer?
You know what? That's a great question there. And that's one of the things. So as you know, Nicole, I get coaching, and my coach actually talked about this today on our coaching call. Make sure that we can issue pre-approvals without the contingency attached, because that financial contingency can be a big deal. We have people that are oftentimes putting down more money. We can rework the numbers to make sure that that income ratio isn't going to be a pain. If they're going to rent the home out, I have the ability to say, hey, listen, I know you haven't decided if you're going to sell or rent, but if you want to rent the home out, we can get what's called a 1007 appraisal on your current home that shows what the rental amount will be on said home to offset the mortgage payment, thus reducing your debt to income ratio. Now, I can only do that on a conventional mortgage. FHA is not as friendly, but in moments, we typically try to find a way to make sure that we can make sure that contingency is not in place for them so they qualify right away.
Okay. Again, your answer has prompted another question. I am loving this. So listen, you said you could do that on a conventional, not an FHA, but sometimes my buyers are novice, not my buyers, my audience is novice, and they don't always know the lingo that we speak. So what exactly do you mean by a conventional loan versus an FHA loan?
So there are a handful of true loan programs that we use, right? And the way that I explained to somebody else earlier is that you can wear shoes from Nikes, Adidas, Reebok, or whatever, right? They're all shoes, but they all serve a different purpose. You wouldn't wear Timberlands to the racetrack, at least you should, right? So there's always something for a time and a place. Where your down payment scale is, your credit score, your housing history is going to let me know.
You blanked out for a second when that call was coming through. So back up just a second.
Depending on where you are credit-wise, income-wise, and asset-wise, it's going to let me know where you need to be at from a loan program. So my people that normally have higher credit scores, I urge them to go conventional, because conventional has great rates just like every other program. But the mortgage insurance, which is the insurance that protects the bank, not the buyer. But if you're putting down less than 20%, you're obligated to have mortgage insurance. So with that, I say go conventional, because that mortgage insurance is only until you get 20% equity in your home. Whereas FHA, which is a great program, often confused with the first-time home buyer program. It's not first-time home buyer. Move up, people can use it as well. right? But that program is for people that have either higher debt to income ratios or lower credit scores, right?
Mm-hmm.
You've served in the military in active duty, or you've done your 8 years in reserves, you're qualified for the VA as long as you have an honorable discharge. The VA is 100% financing with no monthly mortgage insurance. There's an upfront funding fee that's stacked on top of your loan amount, right? But if you're disabled by any means with the VA, so if you get any level of disability with the VA, then you don't have to pay that fee either, or stack on top of your loan amount. For our rural areas, which is really hard to determine what exactly is rural, because I live here in Peach Orchard, which is Charlotte, but right down the road there's a rural area which is also Charlotte, but Charlotte's still a city. It's a big city. But that's USDA. USDA is 100% financing. It's simply geared towards rural areas, and individuals within a certain price point, or should I say financial bracket. But the financial bracket now goes up to actually goes up over $100,000 now, depending on your household size.
Wow.
I know, and it used to be like low income. Now it's
right. You get a house, and you get a house. Exactly. Okay. Well, George, you have been doing it up tonight, answering some questions again. Ladies and gentlemen, for those of you that are just joining us, I do have George Wise, with Summit Funding, Senior Loan Officer, been in the industry almost as long as I've been living in Charlotte, about 14 years now. He's been in this industry, killing the game, winning awards, and doing a thing. And we've got him on the line asking some questions. So if you have questions, drop them in the chat so we can get your questions answered. Again, we do these lives, number one, so that we can get you the information. We're not doing these lives to try to get you to come do business with us. We want people to be out there and be out there informed, okay, and be knowledgeable, okay, because real estate is ever changing, okay. George said when he got in the industry, he got in right before the crash happened. So, he had to learn how to shift, okay. I got in not too long after that when the crash happened. In fact, I bought my first house in 2008. That was right in the middle of it. Okay, but a lot of things have changed. People back then were like, oh my God, I gotta have a foreclosure. I gotta have a HUD house. I gotta have a short sale. You are lucky if you can find such a thing today. Everything is flying off the market, and it's flying off really, really fast. So definitely, if you have some questions, I want to make sure that you put them in the chat box so that we can get Mr. Wise here to answer them while we have him. Okay, y'all asked for me. You said, Nicole, you bringing all these women on. You don't have no men on, so I got a man, okay? I'm catering to you all right? I think they just wanted some eye candy, George.
I'll tell you, I'm here on my side of the fence, and I spoke to a guy today, 750 credit score, it makes really good money. And he said, George, I don't know if I can afford to buy a house right now because I don't have the 20% down. I find a lot of people still believe they need 20% down. Oftentimes you can get into the home with as little as 3% down, 3.5% down. And there are some programs out there that offer assistance to certain people to get into the home. Now, as you're aware, that's not something that I personally provide. I do have a member of my team that can help with that. But a lot of them are offering these no down payment programs that can help individuals that need some assistance getting in the home. What we like to do on our side of the fence is people that feel like there's a challenge to buying a home. I love to do a one-on-one consultation with them and figure out what their challenge is, what they perceive to be a challenge. And I will tell you 9 times out of 10 that I speak to these people, there's never a challenge. Most of these folks are ready to buy today. They just read something online that told them they were not. And it's just like WebMD. If you read WebMD, you're going to think the worst thing possible is going on, right? It's the same thing when you're looking at mortgages. If you Google anything from a mortgage point of view, you're going to think that you cannot get a home. You're going to think that you absolutely cannot get a home, and it's not true. Guidelines change all the time. I would dare to say that guidelines change at least a dozen times in a year. And keep in mind, only 12 months in a year. They change often. So what was true back in 2008, 9, 10, 20, right? It may not be true today. So we have to be there to answer those questions for people to let them know that just because something online says you don't qualify does not mean that you do not qualify. We are here to help you walk through that process together.
I can't stress what you just said enough. I have had so many people just in the last few days say, hey, look, I don't want to have my credit pulled because I don't know if I'm ready. Well, the only way for us to find out if you're ready is for us to pull it. We got to get you with the loan officer. You don't know where you're going if you don't know where you at.
That's right. You got to realize the cost of rent has gone up drastically over the past 10 years, whereas the cost of living has gone up as well, but incomes haven't gone up. What that says to me is that you need to get in and buy a home now where you can fix your housing expense and not be subjected to what the market determines your housing expense should be. Because if your income is not going up at 12% a year, where housing may be going up at 6% a year, you may not be able to afford to find housing. So, being out there waiting until that perfect time is not ideal. And the good thing about buying now, before housing expenses continue to go up, as rent goes up, more people buy. The more people buy, the more the home prices go up. If you get it now, in 5 years, the home you buy for $250, $300, you might be able to resell for $325, $400, right? And you got to stay somewhere. And on top of the equity you gain in your property, you get a tax credit for owning a home, and you get a fixed housing expense. A lot of folks are afraid of increasing or maintaining their current financial situation from a housing point of view without understanding the benefit they get back from and the security they get back from owning a home. Oh, hey, baby.
Hi, little one.
Hey, baby. Come on, come over here. You're here now. Come on. Okay, well, you choose. Do what you want to do.
Well, you see, we've got a new guest. She seems to be hiding behind your back now.
She's hiding behind my back, poking me.
Well, George, you said something that prompted, of course, yet another question. And that question is in regards to equity. So what if someone has been in their house for a while? In fact, someone texted me this earlier today. And they said, hey, a friend of mine's got a house. They've got about 60K in equity. They don't really know, what they should do, if it's a good time to sell it and get something else. How is, when people have that much kind of equity in their house, how is it used if they're thinking about selling it and moving into another home?
Well, you got a number of things that I'm seeing lately. If you have a lot of equity in your home, that's a great time to be a move-up buyer. You sell the home, you pull out the equity at closing and use some or all of those funds to go towards the down payment of your next home. When they're going to sell their home, take some of that equity and put it down on the new home, and then take some of the equity that they still have left over and put it in a nest egg for retirement, right? One thing that we're really big on our side of the fence is not only just getting you into a home, but help you seek financial independence. Just like you, Cole, we work with a ton of financial investors and individuals to help our clients reach financial freedom. The best thing that I can get is put someone into a home and they call me back, 7, 10 years later saying they're looking at my videos, they're watching the tips, the things that we give our clients, and they've paid off their home, right? Now, another thing that some folks do, if you buy your dream home, and you have equity in it, and let's say you bought where rates were a tad bit higher, right? If that's the case, you refinance and pull some money out, and you can use that money for a down payment on an investment home. I have a client doing that right now. They bought a home 3 years ago. Their home, they bought it for, I think, $210, is worth about $300 now. They poured out some money, they're buying an investment home. It's going to be a great investment for not only them, but for their children and generations to come. So, we're going to make sure that we're helping you gain financial independence, whatever that looks like to you.
And what about people who are just trying to refinance? As I know that interest rates are extremely low, okay, but how do they know when to refinance and when not to refinance?
So if you're going to refinance, you should consult with a lender that you feel like actually cares about you and has a moral compass. If you're going to drop your rate, at least, most people say about a half a point or 3/4 of a point. I say a full point. Now, I think that's also market specific. If you are in an area where the average sales price is $650, $700, then a half point goes a long way, right? in our market, where I think the average price was 325 as of recently. You know, I think a full point is what you want to look for, because there are some costs to refinancing. And I want to make sure that if you refinance, that you at least make a profit on your refinance. There's no point of lowering your rate now if you're stripping your equity later. You know, so if you're refinance with us, we're going to make sure that you have great benefit in your refinance, first and foremost. So, you know, there's that. But if you have like a rate that's 5.25, refinance now. You know, I hear people all the time say, I want to refinance my home, but I only have a 680 score, and I know I can't get the 2.75 rate, but I got a 5.25 now. Who cares? Get a 3.25. Rates are going to go up. Get a 3.25 and be happy with it, right? You're going to save a ton of money. So if you can shorten your term or lower your payment by, you know, what you deem to be substantial from a monthly point of view, or you can roll in some bad debt into your mortgage, refinance. I've had people before that have 150 grand in equity in their home, but yet somehow managed to get, life happened. You know, someone got sick, they got $40,000-$50,000 of credit card debt trying to stay afloat. Now they're back on their feet and they want to go ahead and stop paying $3,000-$4,000 a month on bad debt. Refinance it. If you got a 5%, 4.5%, we refinance, we roll the debt into your mortgage. It now becomes, instead of a liability, a tax benefit, right?
Mm-hmm.
And you get rid of that debt right away. You're not paying $2,000 a month. Now imagine if you were sitting there paying your mortgage that was $1,500 a month, right? And then you're paying $1,000 a month in bad debt. And we roll all that in together, but your mortgage payment only goes from $1,500. So let's say it goes up to $1,600. But yet you keep putting that other $1,900 or even half of that money back into your principal balance every single month. You're going to knock 8 to 10 years off your mortgage. 8 to 10 years, so let's call it 84 months on the low end, to 7 years, at $1,000 a month. You paying off that $30,000 in your mortgage, knocked out $74,000 in interest if you do it that way, plus the $1,000 you're able to save a month for your nest egg. Right?
Wow. That's a lot of money.
That is a ton of money.
Could you use an extra $74,000, audience? I'm just saying.
Listen, I can use the extra $74.
Right, right.
She can spend money.
Show me the money.
She can spend money.
Look like she might be going to sleep over there.
Yeah, she's trying to get sleepy on me.
Oh, such a sweetie. So let's see, audience, y'all got any more questions for George? This is an hour-long program, so make sure that you do have questions, you get them answered. I did have, what'd you say?
Did that go to Shia?
Yeah, I did have a question that came to me via Instagram, okay? And so the person said, what does your credit score need to be to refinance?
So to refinance, I mean, in theory, at least a 580. Once again, that comes down to benefit, right? And what's the purpose of refinancing? But at least a 580 for FHA refinance, for conventional refinance. Conventional goes down to a 620, but just because you have a 620 doesn't mean that you're going to get approved. I'd normally tell people that with conventional, you want to be at least a 680 or above. Conventional cares a lot about your credit, your debt to income ratio. They care a lot. FHA cares as well, but maybe not as much as conventional. So, excuse me, with that being the case, with the 580, you can refinance if it makes sense. If you just want to look at a refinance, what I'll tell you, have them call me, whether they go with me or not, it's not important, but I will talk them through the benefit portion at least. We're very purchase based on my side of the fence. I think last year, 94% of our business was purchase based. We'll do the refinance when it makes perfect sense. But what I'm not into is equity stripping, and giving people.
Which is?
So equity stripping is when I'm refinancing a home without any real benefit or mild benefit, and then I'm adding closing costs to your loan, thus removing the equity from your home, right? So I'm not going to do equity stripping. If I do that and you decide that you want to sell your home 2 years later, you might have saved $40 a month, over 24 months. But if it costs you $6,000, you lost. I'm not in the business of losing money.
You see that, y'all? He is telling you the truth. And that's what we want. That's all we want is the truth, right? That's it. So listen, are you able to refinance from an FHA loan to a conventional loan?
Yes, and I have a ton of clients that do that. And the reason being is that, let's say in this market, home prices are going up left and right, right?
Yes.
So with home prices going up left and right, you get into a home because you only have 3.5% down, which is fine to get you to a home. But after a year or two in that home, you may have 10, 15% equity in that home. So what I'll do is I'll refinance the person from FHA to conventional, and hopefully, if we can, reduce the interest rate. If we can't, the main purpose is getting rid of the mortgage insurance, which is almost 1% by itself. The mortgage insurance is super important. So oftentimes, I'll have folks that come in and have a 4.25% interest rate FHA because they bought in 2019, right? And then I'm able to refinance them to a conventional mortgage, remove the mortgage insurance, and drop the interest rate, where what would have been $150 savings is now closer to $300. When you got extra $300 in your pocketbook, you can do a whole lot.
Now, I've had people come to me and say that they've received notifications or mailers where someone is saying, well, we can streamline your loan. What exactly does that mean, and what's the criteria for that?
So a stream is a refinance for FHA to FHA, and with VA, it's called an IRRRL. Now, what that basically means is you don't have to get an appraisal. The streamline process has changed drastically over the years, drastically. Some banks do them non-credit qualifying, meaning they're not going to pull a credit report. Typically speaking, that means that bank already owns the debt, that they're servicing the loan. Normally, they don't go from a person they don't own the loan with somebody else without checking credit. Depending on where you go to get those done, the rates can be drastically lower. I have a broker buddy who specializes in FHA streamlines, right? Buying the market with those. So when people come to me for FHA streamline, I send them to him every time, right? Because there are things that we do that he can't do, and he refers us in return. But the FHA streamline, that's what it is. Years ago, especially in 2008, when you bought your home, they were a big hit. You just had to be on time for your mortgage payment at that time, and we can drop your rate 1-2 points. We were able to roll in closing costs and a lot of amazing things. They've tightened the rules now where that's not necessarily the case. My opinion, strictly my opinion, is that they changed some of the rules because they were allowing people to roll in almost an unlimited amount of closing costs on home, expecting the equity to be there, only to find out that the home wasn't worth the amount that we streamlined for after rolling in closing costs. So now they're saying we'll allow up to X amount to be rolled into the loan, which they know is less than 100% equity in the home, 100% loan to value, because you had to put down 3.5% of the home to protect their investment. That's my opinion of it. However, a streamline is good. If I'm going to refinance someone, I'm probably not doing a streamline. I'm looking to go from FHA to conventional. I'm looking to get rid of your mortgage insurance the best that I can. Unless you have just like a crazy high rate, then we can talk about a streamline. Another thing with streamline, they get these flyers in the mail saying streamline no cost, streamline no cost. Not true. So what they're not telling you is that they're saying streamline no cost, and no cost, and they offer you a 3.25 interest rate. Well, the actual interest rate is 2.75. That difference between 2.75 to 3.25 is where you are actually paying your closing costs. But they're not going to tell you that. And when they send these things in mail, they normally send them like the government has now issued this new, streamlines have been around for forever. It's always been. So you want to be careful when you're refinancing your home. If there's not really something substantial changing in your financial situation through a refinance or a streamline.
Okay, let me ask you this. I'm gonna ask one more question, and then some questions in the chats. When it's a seller who's trying to refinance, okay, but they've got do you guys take into account repairs on the home or needed repairs? Does that factor in any way?
So you say a seller that's trying to refinance?
Yeah, everything's buyer seller to me. So,
Yeah.
but someone who currently
If
already owns their home and
someone,
they're just trying to refinance.
and I wanted to make sure I specialize there, because if your home is active on the market, even one day off, we're not going to touch it. No one's going to touch it.
Well, that's good. I didn't mean that
Yeah.
that person that's on the market though.
So,
Sorry.
but yeah, so someone that wants to refinance the home, what was the question again there? I'm sorry.
How do you factor in repairs or needed repairs on the home? Are you all looking at that? Are we sending somebody out to assess that?
It all depends. So if it's a solid conventional mortgage, and we run our automated underwriting findings, so it's an online platform specific to us that we, lenders are the only ones that have software to. The general consumer doesn't have that. And then Fannie Mae or Freddie Mac, if it's conventional mortgage, will say, hey, we don't need an appraisal. In those moments, we don't know if we need repairs or not, right? If we don't get an automated underwriting approval or waiver of appraisal, we will send an appraiser out to the home, and he or she will tell us if there's anything wrong with the home that makes it unlivable. Now, typically speaking, 97% of homes do not have these conditions on them, right? There are some, but most of them do not. And what they do is typically like you have a hole in the wall, you've pulled up floors, there's a hole in your roof. There's something there that really jumps out that says, hey, this is a problem. But we're not sending a true inspector to the home saying, hey, go tear the home up from top to bottom and let us know what the crawl space looks like. We're not doing that.
Right. Okay. We have, if you're married and want to buy a home, but don't want to add both people to the loan, is this possible to do?
Yes, it is. And if you can qualify with one person, I recommend it. So if you're buying a home in North Carolina, first and foremost, understand that the note is the debt, the loan. That's the note, right? In North Carolina, the note is the debt. The deed is the ownership to the house. So it's quite possible that one person can carry the debt, but both people own the home. And in North Carolina, if you're married and one of you is buying a home, you both own that home. Now, South Carolina acts a little different. You don't have to go on the mortgage in South Carolina. And we call them something different in each state, right?
Mm-hmm.
So the
Right.
note is a mortgage, but you don't have to go on the mortgage or the deed in South Carolina either. But North Carolina, you're automatic on the deed. The reason why I recommend that one person goes on the debt by themselves, Lord forbid we go through another recession, hovering depression, and that home goes into foreclosure, one person can quit claim the name off the deed, take the name off the deed. The other person suffers the loss, and typically the person that has the note, the debt in their name, will suffer the loss. What that means to you is that the other person can turn around and buy another home almost immediately because their credit has not been ruined and they don't have a foreclosure against them right now. So if one person can buy, one person buy by themselves.
Wow. These are some good nuggets you dropping, George. Yes. See, y'all, this is what I told y'all. We keep doing this, okay? You're like, you can't possibly have told us nothing we don't already know, Nicole, but yes, there is. All right. How many years do you have to be earning income from part-time or your side job before you'll be able to count that income for a home loan? That's a very good question. We actually, and all the lenders that I have, we haven't had that question yet.
2 years consecutively. Here's what I mean. You have job number one, which is your primary job. And you have part-time job. You have to work both of them nonstop. And I don't mean 7 days a week, but you can't have the gaps in employments from both jobs. You cannot do that. Now, your part-time job can be seasonal, right? You can work at Macy's every Christmas. And after 2 years there, we can count that. However, if you have a 3-week gap, a 2-week gap, anywhere between both of those jobs, you start over. We're not counting it. And the thing is that we want to make sure that people are going to continue to do that and not get burnt out. Working 2 jobs at the same time is a challenge. And a lot of folks can't do it. And somehow someone that makes the mortgage guideline says if you do it for 2 years, you're likely able to continue to do it, right? So under 2 years, we don't know. 2 years or more, you're okay with us.
What about temp jobs? Like someone who has a temp job and they just literally just from temp job to temp job through the same temp service though.
My answer is going to be no. Someone is going to try it. Someone may get lucky, they may not. My answer is going to be no. And my answer is going to be no because I'm not going to play Russian roulette with your income, right? And with your earnest money and your due diligence. I'm not going to do so. The true guideline is temp income is variable income. For you to be able to count that variable income as true income, it has to be traditional for your industry. Now, if you are a contractor, a project manager, and you're going from contract to contract, which is really temp to temp, yes, I can do that all day long. But if you're a receptionist going from office to office, I can't do that because there's not that quote unquote professional need for that as a contract employee. So it really depends on the industry that you're in. If you get me to say, yes, I can do that. But if you're going contract to contract and you are doing something that requires a level of training or degree or something along those lines to do so, yes, I can do that, at least a certification. But if not, it really becomes a challenge to convince an underwriter, listen, she's been on this temp service for 2 years, you know, she's never missed a beat, back to back to back. They're going to say, well, how do I know she's going to continue to do it for the next 3 years and they'll continue to have work? At that point, we have to go and ask that company, will they continue to maintain you? And they're going to always say no.
Answered my question. My next one. Oh, man.
That company's going to always say, we cannot guarantee there's going to be work for this person beyond this contract. That is always the answer because they don't want to put themselves out there for the liability.
Okay. All right. We haven't talked about this, and this is always a big one that we encounter. Student loans.
Ooh, my favorite.
Dun, dun, dun.
Oh, my favorite. Ooh, student loans. The biggest debt that most people have. My God.
So, I have someone, their student loans are not amortized, if you will. They're on some type of graduated payment. So maybe I'm paying $100 a month for 5 years, then I go to $300 a month for 5 more years, then $500 a month for 5 more years. Can we work with that?
Graduated? No. Graduated is going to be a firm no. So your student loans are going to be contingent upon the loan program, right? That's back when we go back to that Nike Adidas analogy. So if you're going conventional, we can use, and with conventional, we have Fannie Mae, Freddie Mac. I explained them as left Twix, right Twix, right? They both do the same thing, but slightly different. So with Fannie Mae, they're going to say, listen, if it's in graduated or in deferment or forbearance, we're going to count 1%, right? If it's in an income-based repayment, we will count the income-based repayment, even if the income-based repayment is $0 a month, right? However, if you're going to Freddie Mac, they're going to say, hey, listen, if it's $0 a month in income base, we're counting 0.5%. We're not doing $0. However, if it's income based and it's $1 or more, we'll count whatever that payment is. So they won't do 0, they will do 1. That's conventional. And keep in mind, conventional loan programs for individuals that have, typically slightly higher credit scores or better down payment. FHA, they're going to want either a fully amortized payment, which means that if you make this payment today, the same payment today, for the next 20, 30, whatever years that you're on, that balance will end up 0 after that term. Or they're going to count 1% of your balance. USDA, 0.5% of the balance. VA is now doing 0.5% of the balance or the income base. So every loan program has their own take on it. Every loan program has their own take on it.
I remember when I was buying my second house, y'all can learn from my example, y'all. I always teach off of me. I said to the loan officer, I said, what do you mean the guideline changed? Last summer you said She was like, that was last summer. Okay. Real estate loans, it's all ever changing. Okay. That's what you have to understand. They're not telling you one thing to keep you from getting a house. The guidelines keep changing. The guidelines instantly changed the second we shut down for COVID, did it not?
They sure did. The second we shut down, the guidelines have changed and drastically changed. We all learned mortgages all over the first time when it changed. Like all of us did. It was an absolute learning curve for all of us. You know, I think it was 3 years back now, I want to say, USDA used to do income-based repayments, right, for student loans. Well, one day they came out and said, as of today, we don't do that anymore. And we don't care where your loan is at in the process. Do you know how people you were approved?
Say that again.
Say, do you know how tough it is to tell people you were approved yesterday, but not today?
Oh.
So
Did
much.
people slash your tires? Like, were they coming to find you?
And that's that's a tough call. Listen, I understand yesterday I said we were set to go, but today the government said they don't like you. I'm sorry. There's nothing I can do about it.
That's tough.
That's super tough. You know what? That's another reason why it's even more necessary to be prepared up front, because if we close fast, we don't have to worry about those surprises. We have a good chance of beating those surprises. That's why it's important to be prepared right up front. Now, typically speaking, when I pre-approve people, I try my best not to pre-approve them at their absolute max. I love to same room for surprises. I love that ability. You know, I've had clients in the past where they didn't know that their great auntie left them 3 homes or some land in the middle of Nebraska. And I've literally seen this happen a number of times. Wow. Family member left them land somewhere. They knew nothing about it. However, we using databases that are going to find everything about you. Right before closing, we run a few last minute checks to say, hold up, you own 7 acres in Nebraska. Why didn't you tell us that? And the buyer's like, I don't own any dirt in that area. So we have to go through and find all of the lineage from where it came from. It's like, well, do you know this lady? Yes, that's her. Did you know that she left you this? I did not. Well, these 7 acres have taxes on them for $8,000 a year. That's your responsibility. We have to now calculate it, right? So those are things that I like to make sure that we carve out room for the unknown.
Mm-hmm. All right. Another question. I know an application, a formal application, you know, we always tell people, fill out the app, fill out the app. I know an application, okay, there's a formal way to tell you your numbers, but is there an informal way that you can loosely get a guesstimate of how much home you can qualify for based off your income only?
No, because I don't know your debt. Without knowing your debt, I can't tell you what you qualify for. The debt to income ratio is a front end, back end, right? The front end is your monthly income divided by your housing expense, right? So for example, if you make $4,000 a month and your payment is $1,000 a month, your front end debt to income ratio will be 25%, right? And that is P&I, principal and interest. That's going to be your taxes, your insurance, your mortgage insurance, and any HOA dues if you have them as well, right? Your back end debt to income ratio is going to be your housing expense plus anything on your credit report and any tax liability, child support, or alimony payment as well, right? Or if you got to buy here, pay here loan, that goes into your debt to income ratio as well. So without knowing your full debt structure, I can't qualify you. So I've seen people that have 19% debt to income ratios, which is phenomenal, but then have 74% back end debt to income ratios, which is not approvable. And, you know, they say, hey, listen, you know, I make this amount of money. I'm looking for this amount of home. Do I qualify? And I'll tell them, hey, listen, based upon that, yes, you do. But then we pull a credit report and they co-sign for their cousin's BMW and their mom's Aston Martin and all these other things. They have all these other bills that maybe they are not obligated, well, they are obligated to, but they don't pay themselves, but we can't prove the other person pays it either. So we still have to count it against them. Mm-hmm. So now they've gone out and they've set their eyes on this beautiful home and fell in love with it. And I got to be the bad guy and say, hey, you don't qualify because of this other debt. And we see it more than you would imagine. We see it very often, very often. Cosign for anybody, literally anybody.
Ever. Don't do it.
Do it.
Don't do it. Well, George, you know, this has been very, very enlightening, to say the least. I feel like your arms are going to fall off holding that baby there.
I am. He does his also.
Like, if you do this grab one more time to lift her up off your arm.
No, I don't mind how drooling on the suit. Don't drool on my shirt.
Oh.
Actually, drool on the shirt, it goes through to my chest, and that's disgusting to me. I don't like it.
Oh, Tashia says she misses you. Oh, goodness. So we've talked about student loans, everyone. We've talked about, this is just recapping at this point, George. We've talked about student loans. We've talked about debt to income. We've talked about the types of loans that are out there. We've given you examples of what not to do. We've talked about the type of income that you need to be making, as far as you have to have a job, not a temp job. But one of the things that I also wanted to just ask you, we talked about a lot. Y'all go back and watch the whole video if you missed something. We talked a lot of stuff tonight. But George, one thing that I just wanted to ask you, and it goes back to refinancing, okay? All right, because interest rates are low, all right? And so, say that again?
They are crazy right now.
Yeah, they're crazy low. And you had said earlier that someone could pull their equity out and use it to purchase an investment home. Okay. Yep. But what if someone just wanted to kind of do repairs to their current home? Are they able to do that? And if so, what's that called?
Well, you're fishing for 203K. So there is a repair loan, which FHA has one, the convention has one. It is a home repair loan where you can decide if you want to pull equity out, which is a cash out refinance, or if you need to go above that 80% loan of value, you can get contractors to give you estimates, and then we can do repairs and sometimes additions to your current home to make it where you want it to be, right? And the value of your home will be based upon the finished value, not the current value. Those programs take a tad bit longer. You will need a GC, a general contractor involved, but they are great programs. So if someone finds their ideal home and they have to close on a home right away because no one's waiting 60 days to close on a home, buy the home now, give it 6 months, come back and do a renovation loan on it, add that bedroom, add that bathroom, do things you want to do. And in those loans, a lot of times you can take and add in things like washer, dryer, and improve your refrigerator. There's a lot that you can do with those renovation loans.
Okay. And how is the renovation loan different from a home equity line of credit?
So a home equity line is essentially getting a credit card against your home, right? But it's a mortgage. So a home equity line is basically a credit card against your home. Oftentimes it is, and don't panic when I say this, it's an adjustable rate mortgage, but the rate mortgage is called prime. And prime seldom moves. Like almost never. And if it does, it doesn't move enough to move your interest rate. But I do caution people against those HELOCs, home equity line of credits, is that traditionally speaking, they're interest-only loans for the first 10 to 15 years, which means that you can take out $50,000 today and pay on it for 10 to 15 years and look up and still owe $50,000, right? So if you get a home equity line, I encourage you to pay more than the balance. Home equity lines are typically done by credit unions these days. We don't offer them here. There are some banks that still offer them, right? But we're not going to be one that offers them. And most traditional banks do not offer them. Yeah.
Y'all, are y'all taking in this good info? This is, George, thank you. This has been phenomenal info tonight. I hope that you guys were taking notes and digesting this. You know, we got a few questions in there. I saw somebody said, yes, Nicole, I needed that question. Look I'm reading the minds out here. Ensuring that I give you this info. I want to make sure that you all have all your questions answered before we leave this live. Yes, George is a teacher, Hunty. He does all these little tutorials and these webinars and stuff. He is a godsend, if you will. Very, very intelligent. Oh Lord, I think I saw your head start to get a little bigger. Let me stop now.
No. Thankfully.
No, seriously, George is really, really smart. Probably why his last name is Wise, like he literally walks in that name. So the people are shouting you out here. They're saying it was amazing info, great info. So George, they said you tell the truth, honey. And that's what I love about you, honey, because I don't believe in them lies, honey. Well, we don't deal in lies.
Honest to a fault. You know, while I got to share here, and Nicole, you know I love loving my real estate agents, my business partners, and my past clients. To share, keep an eye out. You have an invite coming soon for a event that I'm doing for my past clients at the end of this month. So keep an eye out for that invite. I would love to see you there.
And so if any of you all want to reach out to George, tell them how they can reach out to you.
So you can reach out to the team at 704-895-8770. In regards to an email address, you are welcome to email Carrie Charles on my team, CARRIE.Charles at myccmmortgage.com. And I give you Carrie's information because in the moments that I spearhead things of my own, I will start them and get them going. And when she has to catch everything up, she gives me the look of death. So I've learned to surrender to a woman's plan. Carrie pretty much runs the show on my team, and what she says, I'm her.
Yes, and Carrie is excellent. I talk to Carrie all the time. Carrie, hey, listen, what's going on? This is what I need to know. Like, I don't even call George no more. It's called the officer to ask for Carrie.
Take great care of you.
George, if they wanted to follow you on social media, how can they contact you?
So I would imagine that my Facebook popped up here, George Wise on social media. Make sure you get the one with the picture of me and her. As a matter of fact, it is me and her in the picture. There's a lot of George Wise. Wise is my father, my brother. There are quite a few of us. On Instagram, I am the real George W. CLT. I'm fairly certain that's who I am. The real George W. CLT on Instagram. I'm relatively new-ish to Instagram.
Okay. And as you all know, you can always follow me at Coles Keys on all social media platforms, and make sure that you go to my YouTube page and subscribe so you can get notifications when these live videos get uploaded. Next week, we will actually be talking to a new home builder representative about the new home building process. So we've got some good going on there, and we'll also be talking to a credit expert next week. Ladies and gentlemen, I always, as always, want to be conscious of your time, and I thank you for tuning in. But that's all that we have. We'll see you next week.
Have a good one, Cole. Thank you.